Today's session. Jason Furman is a professor of the practice of economic policy at Harvard Kennedy School. He is also a non-resident fellow at the Peterson Institute for International Economics. This followed 8 years as a top economic advisor to President Obama, including serving as the 28th chairman of the Council of Economic Advisors from August 2013 to January 2017, acting as both President Obama's chief economist and a member of the cabinet. During this time, Furman played a major role in most of the major economic policies of the Obama administration. Previously, Furman held a variety of posts in public policy and research. In public policy, he worked at both the Council on Economic Advisors and National Economic Council during the Clinton administration, and also at the World Bank. In research, Furman was a director of the Hamilton Project and senior fellow at the Brookings Institution, and also has served in visiting positions at various universities, including NYU's Wagner Graduate School of Public Policy. Furman has conducted research in a wide range of areas, including fiscal policy, tax policy, health economics, social security, technology policy, and domestic and international macroeconomics. In addition to articles in scholarly journals and periodicals, he is the editor of 2 books on economic policy. Furman holds a PhD in economics from Harvard University. So I want to thank you very much, Professor Furman, for hosting our first executive education webinar, and I'm going to turn it over to you.
Great. Thank you so much, Erica. And hopefully when you send it out tomorrow, you could also send out the slides to people as well so they can have them. Great. So thanks to all of you for joining on this executive education webinar. It's, in some ways we don't get the in-person interaction that I love from the executive education sessions that I've done. But we're also have so many people that were able to join us today, which is really exciting and really great. We're going right now through the most traumatic economic event that the world has gone through in 90 years. It's tragic in terms of health. It will be far-reaching in terms of its consequences for politics. But just purely on economics alone, it's the worst economic crisis to hit the world since the Great Depression. You have simultaneous shutdowns in economic activity that have been large and rapid, all over the world simultaneously. If the United States was immune to the virus, we would still probably have a recession just because of the global impact on global trade, global supply chains, global capital flows, and the like. What I'm going to talk about today is, what's going on in the economy, what's being done about it, and what can be done about it. And I'm going to cover in particular 4 topics. I'm going to give you an overall economic framework, which is how I think about what's going on in the economy, what's going on with economic data, and what you should all be looking for going forward. Then talk about what the data so far says about that overall economic framework, what we know both from the official statistics and from a variety of other daily economic data. We'll talk some about the policy response so far. We'll do monetary policy very briefly, and I'll focus really on fiscal policy. That brings up a big issue that's on many people's minds, of the deficit and debt. I want to fully address that with all of you. And then finally tell you what I think coming out of this analysis should come next. There'll be a decent amount of time at the end of this for questions, so definitely put your questions in the Q&A box, and I'll come back when I've finished all of these topics to address them. So let's start with the overall economic framework. This is the stylized way I think about the 3 phases of the COVID-19 economic crisis. The first phase is a collapse in economic activity. That is a large, abrupt, dramatic decline that we have seen, with activity being about 15% below what it would normally be, happening all over the world, different times, earlier in China, then in Italy, then in many other countries. That's what we've gone through so far. We're now at the very beginning of what I call the partial bounce back. That's the second phase of all of this, the collapse being the first phase. The partial bounce back is a type of economic growth that you normally see after a natural disaster. It's a business turned the lights off, it turns them back on. A person was furloughed, that person goes back to the same job they were furloughed from. That type of economic growth can be very rapid and is, after natural disaster, it would get you all the way back up to your baseline. Last month, we saw 20.5 million jobs lost in the United States. Later this year, we are probably going to see multiple months of 1, 2, 3 million jobs created. There'll be some of the fastest job growth we've ever seen. It might be the third quarter that we see the fastest economic growth that we've ever seen. The big question in the partial bounce back, though, is how far does it get you? In the stylized drawing, I've shown it getting you halfway. If you believe in a V-shaped recovery, maybe it gets you most of the way back. If you're much more pessimistic about the virus, a second wave and all of that, maybe it only gets you this far. After the partial bounce back, that's the easy type of economic growth, the turning the lights back on, the going back to your old job. The other type of economic growth is much harder. I'm calling it the slog. It's phase 3. The reason it's much harder is that you need to find a new job because your old job doesn't exist. Even worse, you need to find a new industry because there aren't as many jobs in, let's say, travel and tourism or restaurants or retail trade. And this is the normal type of job growth we have in business cycles. And the problem with the normal type of job growth in business cycles is that you don't see on a sustained basis the unemployment rate falling by more than 1% a year as a general rule. And so this slog is going to be a while. The way I've drawn it, it would take until 2023 to get output back to where it was before. And you never quite get output back to where it would have been. Now, there's a more optimistic scenario with a larger partial bounce back. There's a more pessimistic scenario with a smaller partial bounce back, and which will determine which of these paths that we're on. They all have the same general shape: collapse, fast growth, slow growth, but how far do you get with the partial bounce back? Well, the most important set of factors that will determine that is how much the virus spreads, how we handle the reopening, whether there's a treatment, whether there's a vaccine, when all of those happen. There's another important set of factors, which are monetary policy, fiscal policy, and lending policy. And one of the big insights of economics is about comparative advantage. And my personal comparative advantage is in these topics. And so that's what I'm going to focus on in my comments today. I want you to keep in mind, though, that any money spent speeding up a treatment or vaccine, any money spent expanding testing, a really effective tracing program, all of that is probably even more important than anything we do in economic policy. But economic policy is quite important too. It's what I know about, and so it's what I'm going to share with you today. The last part of the framework I want to leave you with is what will determine how much the partial bounce back happens and how far we need to go with the slug and how long the slug will be, is what ratio of the shocks do we face and how do we respond to them? And what we're seeing right now is a complicated combination. It's both a demand shock, people are spending less. That's the normal source of recessions. That's what happened in the financial crisis. That's what happened in the 2001 recession. That's what happened in the 1990 recession. There's also, though, a supply shock, which is businesses can't produce as much because they can't safely have workers together in large ways. The demand shock is something that is largely solvable with fiscal policy, that's increasing government spending or cutting government taxes, and monetary policy, cutting interest rates, not just on the Fed's policy rate, but on a broader range of interest rates. This one is a supply shock is much harder to solve. There's not some lever you can pull that quickly solves it. So what ratio of this is demand? What ratio of it is supply? And insofar as it's demand, are we pulling the proper levers to deal with that? That's the first big open question that is evolving as we speak. The second issue is whether what we're seeing is more liquidity shock. This business, let's say Ford Motor Company, they're not selling as many cars now. They're not collecting as much money now. They need money to pay their workers to stay alive as a company. So they need to borrow to get through the liquidity. In Ford's case, they can borrow from a public market. Part of why that public market exists is because of Fed programs and the expectation in particular in this case that the Fed will have programs. In some cases, they're direct loans supported by the government. But liquidity shock is fully solvable, not fully solvable, but mostly solvable with lending programs. Solvency shock is much trickier. You can't lend money to an insolvent company. You need bankruptcy to shed your debt. Bankruptcy is a long and painful process, and if you're completely insolvent, you might need a liquidation bankruptcy. So insofar as it's solvency, it's a lot trickier. The third different types of shocks we're seeing are a combination of what I'm calling a stop-start shock, it's not a standard term, and a reallocation shock. Stop-start is you turn the lights out on your business, you put it into a medically induced coma, the entire economy goes to sleep. 2 months later, you wake it up and you wake up exactly the same economy you had when it went to sleep. That is a lot easier to deal with. Tide companies through a month, 2 months, 3 months, whatever you need to, and then you have all the same companies. Reallocation is much trickier. Some businesses fail, other businesses succeed. The number of restaurants goes down, the number of takeout deliveries goes up. That involves creating new businesses, expanding businesses, shifting people between businesses. Again, many fewer economic policy tools to deal with it. So the more these are the problems, and the more we address them, that says a large partial bounce back. The more supply shock, solvency, and reallocation are the problem, that's a lot more challenging. And that's not something we know right now. That's something we'll watch as everything unfolds. So what does the data so far tell us? I'll start with publicly available data, official government data. These are growth rates in the first quarter of the year. The news presents them in different ways for different countries. I'm standardizing. So this is the percent change, not annualized, relative to the fourth quarter of 2019. You see China had a huge contraction compared to the United States. But the IMF expects China's going to grow this year and thinks the United States will contract this year. So in part, this is the different timing of lockdowns. In part, it's an idea that if you lock down more, output goes down more in the short run, but then you can reduce the number of cases and run a better economy after. The European Union is somewhere in between the United States and China with a large lockdown, but also the expectation of very negative growth over the course of the year. The most striking economic statistic to come out of this for the United States is the unemployment rate in April, which rose to 14.7%. That is the highest we've seen since the Great Depression. And it was a faster rise than we saw at any point during the Great Recession. I want to put this unemployment rate in context for you by giving you a lot of different ways to look at it. In an important respect, the unemployment rate is a lot worse than it looks. It was reported to 14.7%, but there were also about 7 million people that left the labor force. They stopped looking for jobs, because who would actually look for a job in the month of April this past year? If you count those people as unemployed, the unemployment rate rises to 19%. There were also another group of about 6 million people that were reported to the government that they were, quote, not at work for other reasons. They were not classified as unemployed, but to all intents and purposes, they weren't working. They weren't working any hours. They weren't getting paid. You count them as unemployed, you're up to 23.5% unemployment rate. And then if you include people who are part-time, not shown here, the unemployment rate goes above 25%. So the actual unemployment rate in April was something north of 20%. What if we just invented a vaccine and delivered it to every single person in the country today? What would happen to the unemployment rate? Well, there were 18 million people who reported themselves on temporary layoff. They would go back to their jobs right away. Let's say no one else loses their jobs. So everyone on temporary layoff goes back to their job. No one else loses their job. In that case, the unemployment rate would still be 8.5%. And so in some sense, the shadow underlying optimistic, everything is solved overnight unemployment rate, and everyone goes back to the jobs they were furloughed from, is 8.5%. To me, that's a substantial amount of evidence that a partial bounce back, when we see one, we're going to see a rapid decline of the unemployment rate, but that it will stall out that decline somewhere at maybe around 10%. The other evidence that there's a substantial amount of reallocation is the breadth of the job losses. There were 20.5 million jobs lost. They were lost in every sector. Yes, there were disproportionate losses in leisure and hospitality, but don't let the axis fool you. In every other sector, job losses were about 10%, give or take. That's a massive job loss, even outside the leisure and hospitality sector. In mining and construction and manufacturing and information and education and government. This is, by the way, state and local government, where those job losses were, something I'll come back to. I often get the question, are you worried about inflation? My answer has been no. And yesterday, so far, the data is vindicating my view. Core inflation, which subtracts out the volatile and energy components, was minus 0.4%. That is the largest decline in core inflation ever. Those data go back to 1957. Financial markets expect inflation to be about 1% over the next decade. They expect that because they think there's a large demand shock, and it's very hard to have inflation when you don't have wage pressures and when commodity prices are falling, not rising. I should, as an aside, say, if the market was wrong and if we get inflation, I think is possible, not likely, but possible, that would be good. It would mean we avoided a deflationary spiral. Lower real interest rates help investment for businesses and foreigners. Lower real wages help employment. And it would mean deleveraging, a reduction in household, corporate, and government debt. So I think inflation's unlikely. If we get it, great news. If you look at consumer spending at a higher frequency, you see it's done by colleagues at Harvard, Raj Chetty, Nathan Hendren, and others. You see consumer spending declined by 30%, and you see the beginnings of the partial bounce back, where about 1/3 of the decline in consumer spending has been made up as you've had to some degree, a partial reopening of the economy. You see something similar in mobility trends that Apple is tracking. Driving, walking, and transit all fell precipitously in the lockdown. Driving and walking have recovered. Transit has still flat at a very low level. I should say these are searches for directions about these. We don't know exactly how much people are driving and walking. Just to compare that to other countries, you see countries like Italy and Ireland are way down in their mobility, at least based on the Apple app. What's interesting though is Hong Kong, Japan, and Korea, all countries we think of as living more normal lives, not locked down, have seen larger reductions in mobility than you currently have in Germany and the United States. And in Sweden, there's basically barely any reduction in mobility. So summarizing, the data so far broadly says it's very, very large. We're seeing the collapse. We're seeing the beginning of the partial bounce back. It's way too soon to know whether the partial bounce back will get us most of the way there, but at least reading the tea leaves on the employment data suggests there's a substantial amount of reallocation, a substantial number of people whose employment has been severed permanently, not just temporarily. And so the partial bounce back will have a hard time getting us more than halfway there. Let's now look at what's happened in policy so far. There is no financial crisis right now. There are no, really aberrant behavior in credit markets, widenings of spreads. Some interest rates are up a little bit. Loans are definitely harder to get for many. But broadly speaking, the shoe that has not dropped is financial crisis. And that's because the Federal Reserve acted really quickly to cut interest rates to zero, and more importantly, to start lots of lending and lots of buying. They've bought a lot of Treasury securities, they've bought a lot of mortgage-backed securities, and they have done or announced lending programs for businesses, for states and localities, and in a variety of asset-backed securities for student loans, car loans, and the like. That action, I think, has been, almost flawless, has been very successful. It risks creating a backlash, that a perception that Wall Street has been bailed out and Main Street has not been. That perception is completely wrong. The fact that Ford Motor Company can borrow money means that it's going to be able to employ more people. And so the Wall Street programs help Main Street. And also these programs are essentially not costing anything. There might be some losses on some of them that were appropriated and passed by Congress and authorized effectively by the Treasury. But for the most part, they're buying assets. They're engaged in market-like auctions. And so what they're doing really is liquidity, not solvency. This is not a fiscal action. It's not costing money. And so to complain that the Fed has done too little for Main Street, I think is missing the point. You can then ask, has Congress done enough for Main Street? The largest fiscal response in US history to an economic crisis was in 2010. It was 3% of GDP. In 2020, the fiscal response so far that is 12% of GDP. It is 4 times larger than anything we've ever done to respond to an economic crisis. If you want a parallel to what we've done, you can't look to past economic crises. You have to look to World War II. And what we're doing is about, so far, by the way, and more is coming, what's been done so far is about half of what was done to fight World War II. So we're more on a war footing than we are on a counter-cyclical economic policy footing. There's a lot in this chart. I won't talk about most of it with you. The one thing I'll highlight is the US fiscal response. That's in the red rectangle. That's the standard increased government spending cut government taxes is much smaller, much larger, I mean, than the fiscal response that we've seen in the Euro area, Japan, or the UK. We have smaller automatic stabilizers, but we've taken much larger actions, and in particular, have taken much larger actions on transfers and grants, like unemployment insurance and the checks that households have gotten. How do I think about what's been done on the fiscal side? I think social insurance is fiscal stimulus. If you want to help people get through the shock they're going through, you want to prevent large declines in consumption. That's what economists call consumption smoothing. You want to get money to people who are going to cut their spending a lot because of what they're going through. Those are exactly the same people who have a high marginal propensity to consume, who are going to spend a lot of the money that you're giving them. So the better we do our social insurance, the better we're doing macroeconomic fiscal stimulus. And there is evidence that the households in the United States that have gotten stimulus checks, this is $3,400 for a family of four, are actually spending that money. In fact, spending more of it than I might have expected. So what's policy accomplishing? Maintaining aggregate demand for households, at least as much as you can when there's so much you can't buy. And amazingly, household balance sheets will be better after the crisis than before. People will have less debt, more money in the bank. Why is that? It's because people are spending a lot less right now. If you have a job, you have your income. If you've lost your job, unemployment insurance for the majority of job losers is giving them more money than they were getting from their job. And then on top of all of that, there's the checks that households have gotten. Many people are falling through the cracks. I'll come back to that. Many people are hurting. I don't want to minimize that at all. But when the economy is in a position to function, people will have money that they're able to spend. That's true for households. It's not true for states and localities. I'll come back to that. And it's not true. It's a question how long. The checks went out. Will there be another round of them? Unemployment insurance expires at the end of July. What will happen after that? Those are all big question marks. There's been some argument that Europe is avoiding unemployment and the United States is having unemployment, and that it was avoidable to this unemployment. We could have done without it. I think that argument is overstated quite a lot. In both the United States and Europe, there's a lot of people that can't work right now because their businesses are shut, their businesses aren't producing anything. That's about the same in the United States and Europe. The question is, what do you do with those people? In the United States, they're furloughed. They're not paid by their employer. They get unemployment insurance. In Europe, they're paid by their employer, and the employer is reimbursed by the government. Now, in the United States, workers are actually getting more money in many cases than they were getting on the job. In Europe, they're often getting less money than they were getting on the job. They've had to take a pay cut. In Europe, the businesses also have to chip in some of the money in many cases. So that's going to make it hard for the businesses to do. But broadly speaking, the two systems are the same. If a business is economically viable, they'll reactivate their employees. Disney furloughed its employees. Macy's furloughed its employees. If Disney can open its parks, it will bring those people back. If Macy's can reopen its stores, it will bring those people back. There's not evidence for a much greater labor force attachment in Europe than here. The US system is definitely more disruptive to employees. A lot of difficulties getting through unemployment insurance lines, and I think that's a big problem. But in many cases, it actually pays more than the European system and reduces costs by business for more. Huge caveat around healthcare there that I'll come back to. And finally, insofar as you think it's a reallocation shock, the US response has more optionality around that. There's been a second debate, which is, should you give grants to functioning businesses? In the United States, we've done this in the Paycheck Protection Plan, PPP, which gives money to businesses that have employees. We've done it in the airline program. And there have been proposals from the left of the political spectrum, Bernie Sanders, to the right of the political spectrum, Senator Hawley, to greatly expand grants to functioning businesses, large and small. I think those have had a lot of problems. I'll only be able to rush through this, but there's targeting problems. If your business was going to have active workers, you're getting a windfall. If you weren't going to have workers and you required the workers to come back, you didn't actually help the business become any more solvent than it was going to be. These loans and these grants have been conditioned on maintaining employment. That means if you're AMC movie theaters and your employment went to zero, and in a good case, you're going to be able to hire half of your people, you either don't qualify or have to put yourself in a very different place than you've been. Very worried about the bridge to nowhere problem. Airlines are maintaining complete employment through September 30th with federal money. What happens on October 1st? One of the airline CEOs said they expect full travel to be up and running on October 1st. Not sure I expect that. A business, restaurant that won't be open for a year, it's a hard thing to subsidize for a year. By letting big businesses avoid bankruptcy and restructuring and bankruptcy, you're letting shareholders and bondholders off the hook. And then finally, I'll come back to the fiscal side, but that costs 20% of GDP annually to do this. That's quite expensive to maintain. So overall, I'd summarize the policy response so far. Monetary policy has been, fantastic, almost flawless. Fiscal policy has been very large, very fast. It's gotten a lot of things right. It's also gotten some important things wrong. One thing that has gotten wrong is what it has done, which is grants to businesses. Another thing it's gotten wrong is what it hasn't done, which I'll get to in the last topic of our discussion. But before that, I want to just briefly discuss the issue, another one we could spend an entire hour on, of deficit and debt. This shows the increase in deficits in 2020, and it compares what the IMF expected in October to what the IMF is currently expecting. You see, first of all, the United States has the largest fiscal response. Canada's deficit is deteriorating, in part that though is because oil revenue is declining. So the United States has the largest fiscal response, which means it has the largest increase in the deficit. The other thing to notice is the United States started from the highest deficit already, 5.5, much higher than the deficits you saw elsewhere. As a result of this, the debt is now expected to be above 100% of GDP by the end of this year in France, Italy, Japan, and the United States. In the UK, it could get there in 2021. Only Canada and Germany of the large economies are way below that threshold. Can we afford to have debt at that level? One thing that says that we don't have a big problem constraining our short-run response is that interest rates are low, and in fact, real interest rates have gone negative. One thing to note here, when I was in the Obama administration and we were doing the large fiscal stimulus, real interest rates were about 2%. We did too small a stimulus because Congress wouldn't let us do as large a one as we wanted. But there was at least an argument you could make with a straight face that interest rates were reasonably high. Now interest rates are negative. Doing fiscal stimulus now is much cheaper. There's much less of a limit on it. The market is not screaming out, don't do what you're doing. In fact, I think the market understands that the way to make debt fiscally sustainable is to have GDP. And if you don't do this, you won't have GDP and you won't be able to pay your debt back. And so in some ways, these fiscal actions are increasing fiscal sustainability. It's not just the United States. Real interest rates are negative in most of the G7 economies right now. So what should our priorities be going forward for the next response? Again, I'll focus on fiscal policy, focus on the United States. A lot of this has application around the world as well. I'll list what I think of as the 5 most important priorities, and I'm putting them in rough order that I would prioritize them. Number 1, there have been dramatic state and local budget cuts. This is because states and localities have balanced budget requirements. So when their revenue gets reduced, they have to reduce their spending. These states and localities were all balancing their budget last year, the year before that. They all have mostly have relatively low debt to GDP. A few of them have pension plans that need adjustment, but that's not what caused this problem. What caused this problem was a decline in revenue. And if you look at that total, it's in the neighborhood of $600 billion over 3 years. States and localities, if they don't get any assistance, will have to cut by that much. What would a cut of that much be? It would be everything. You'd have to cut education. You'd have to cut police officers. You'd have to cut parks. You'd have to cut everything. That is a completely avoidable macroeconomic problem. We need state aid. We need it in the neighborhood of $500 billion or more. Second, I said that on aggregate, households are maintaining their balance sheets and will be in somewhat better financial shape after this. That's not true of all households. That's not true of the people lining up at food banks. There also appear to be of the people that have lost their jobs, it appears that about 27 million of them have lost their health insurance as a result. Many of those 27 million are eligible for the Affordable Care Act and eligible for Medicaid, but not all of them are. And so something like expanding eligibility for those and also 100% subsidy for COBRA, so you can keep the health insurance you had on your employer when you leave it, would help in that regard. In terms of the food banks, expanding nutritional assistance, what's called the SNAP program, also expanding eligibility of what's been done to all immigrants and to all dependents. Number 3, in 2008, we did fiscal stimulus when the unemployment rate was below 5%. The last stimulus happened in December 2012 when the unemployment rate was still 8%. I am slightly worried that assistance will go on autopilot and continue longer than it's needed. I am much more worried that it will end prematurely. Why would that happen? Congress gets worried about debt. Congress gets tired of doing fiscal stimulus. It looks like the economy is improving because the unemployment rate went up to 15 and the unemployment rate's come down, and now it's, in quotes, only 10% unemployment. We're making progress. We don't need stimulus. I've been there. I've seen that sentiment happen. It's a big problem for the economy. It's a big problem for families. What we should be doing is right now putting triggers into the law so that as long as the unemployment rate is above 6%, we'll continue doing blank action. You can make them fancier. I have proposals that would do it on a state-by-state basis for assistance from Medicaid, for example. Priority number 4. We're going to have a shortage of jobs in 2021, in 2022, and beyond. Infrastructure investment is not the number 1 priority. It doesn't matter that Congress didn't pass it in April. They can wait a little bit to pass it, but it takes a year or 2 to spend out. That's not a problem. We're going to need it a year or 2 for now. So this should not crowd out the immediate crisis response. No one should be confused that it's an immediate crisis response, but we're going to need more infrastructure. And then we're going to also need training. One of the most effective forms of training is community college. Many of them are being slammed by the economics of what's happening now, making sure that we're helping train people to reallocate them to other parts of the economy, which is going to be needed. Finally, this crisis has exposed, second to last, this crisis has exposed a long-standing problem in the US economy, which is an inadequate safety net. If you look at the countries in the world that don't have paid leave and sick leave, it is Papua New Guinea, it is Suriname, it is these 3 islands, and I'm not quite sure what they are, apologies, and it is the United States of America. That's made it harder for us to deal with the crisis we're in now. It needs to be fixed. It needs to be fixed as soon as possible on a permanent basis, not a temporary basis. Finally, I want to end on a tiny bit of a downer note. I've just talked about a lot of things that cost money. Infrastructure we could pay for with a gas tax. Paid leave we could pay for with a small payroll tax. But we're still going to be in a situation with a high amount of debt. Now, this is a complicated slide. I'll just simplify. If we want debt to be 150% of GDP, I think that's perfectly tolerable. It's way higher than what most people were talking at 6 months ago. 6 months ago, I actually thought it was perfectly tolerable. Let's say the growth rate is 2 points higher than the interest rate, which is reasonably optimistic. That says you're partly going to outgrow your debt. And it says you actually can run a deficit of 3% of GDP, counting interest on government debt, that it's okay to run a deficit. You can't run an unlimited deficit, but you can run a deficit of 3% of GDP in this somewhat optimistic case to keep the debt at 150. Now, if you want to keep the debt at 100, if you think the growth rate is going to be roughly equal to the interest rate, then you need something a lot closer to a balanced budget. But for me, I'm comfortable with this debt. I'm comfortable with this optimism. But maybe you think that's needed. Well, where are we right now? Currently, the primary deficit is last year, before the stimulus, was 3% of GDP. It's expected to stay there, but if all tax cuts are continued, it'll go to 4.9% of GDP. And so we could stabilize the debt at around this level just by not extending the tax cuts. And that says we would need to pay for everything else we're doing. A semi-optimistic message, if you're somewhat optimistic about the economy and somewhat willing to have that level of debt. Would summarize by saying, what we're going through as a world is terrible. What we're going through as an economy is terrible. Macroeconomic policy can't solve it. A treatment can, a virus can, especially can, but it can ease the pain for families. If it eases the pain for families, it will help ease the pain for the economy as a whole. If it helps ease the pain for the economy as a whole, that will actually make some of the health measures we need to take more tolerable as well. Policy's been better than I expected. It hasn't been good enough, and it's going to need to stay at the job. So that concludes the comments I was going to make. There's an awful lot of questions that have come through, and I'll try to pause for a moment and take a look at them and get to whatever I can. So I will take a drink of water. So there's one question about from Rajiv Saxena from India about, should we focus more on the short term or the medium term? The answer is both. If you have a limited political appetite and attention span, do the short term now, because you can always come back and do the midterm. So, I would love the United States to do all 6 of the things I mentioned before, but I think it's too much for Congress to pass. So I think infrastructure, training, taxes, those can wait a little bit of time if they need to be. monetary policy has a little bit of room to move in most countries, but only a little bit. In most countries, it's used all that room. So really, it's fiscal policy that has to be the biggest focus. Now, that's easy to say from the United States, where we have a lot of ability to borrow. It's a lot harder for many emerging markets, for countries like India, that do have more of a fiscal constraint. The question about transparency and accountability. I think the transparency in the United States has been, and accountability has been a real problem, with firing IGs, with not releasing information. So I think more transparency and accountability is important. Flexibility, though, is really important too. The Fed can't anticipate everything it's going to use with its money, every way it's going to use its tools. And so I think we do need to give central banks a lot of latitude, not have legislators tell them exactly what to do. But in exchange for that, the central banks need to, in a very timely manner, say exactly what it is they've been done and held account for what it is to be done. So John Jennings asks a question I get quite a lot, which is, can you summarize MMT and does it apply to our current situation? To do a little bit of a glib, facetious comment first, and then I'll be a tiny bit less glib. I think MMT, which is modern monetary theory, is this theory that you can effectively borrow an unlimited amount. Now, there's lots of different versions. There's popular versions, academic versions. They keep changing. And so some would say that's unfair, but broadly speaking, that's the way the political system has interpreted it. I think MMT is like a broken clock that is correct twice a day. I think we are currently in one of those moments. So the MMT recommendations for right now are exactly the same as the non-MMT recommendations, which is borrow a lot of money, use a lot of fiscal policy, make that the priority. Ultimately, though, there is some fiscal constraint somewhere. There's some supply side constraint somewhere. The government can print money to monetize the debt, but the way central banks do that is by issuing something called reserves. So they buy government debt, but they issue reserves. The thing about reserves is the central banks pay interest on those reserves. And so the central banks are actually borrowing money at interest, often short-term borrowing, which leaves us susceptible to rate increases. So there's no printing money simple way out of all of this. So in that sense, I think MMT is not correct. Razvan asks the very simple question, how do you assess the likelihood that the crisis may turn into a financial crisis later? So later is an important word in your question, Razvan. That shoe has not dropped yet. The central banks, not just in the United States, but in emerging markets as well, have really prevented financial crises. In the United States, there's also a lot of additional resources that the bank has that it hasn't deployed yet that it could if needed. So I think there is a lot of space to deal with it. I think if the economy is where it is right now for 6 straight months and Congress doesn't give more money to the central bank to deal with solvency of financial institutions, then maybe you could have a financial crisis. There's a separate issue of emerging markets. They faced massive capital outflows in March. They had some capital inflows in April. The situation stabilized. Interest rates in a lot of them stabilized. But the IMF estimates it's going to get $2.5 trillion of requests from emerging markets. It is only allowed to lend $1 trillion. And so I am more worried about emerging market financial crises. That is not all of them. That would be differentiated. It would very much depend on the situation a country was in going into this and the level of trust that capital markets have. We need the slides. Is it going to be shared? I think the slides will be shared along with a recording of the video tomorrow. But if you don't get them by the end of the day tomorrow in an email from HKS, send me an email, jason_Furman@harvard.edu. Happy to share the slides with you. I'm also going to put them up on Twitter later, so you can look for them there. An anonymous person wants to know more about U.S. state and local impacts and the policy options. The policy options for states and localities are terrible. They can't raise revenue very much right now. They can't get out of their balanced budget requirements. And so they need to cut their spending to match their revenue. You know, how do you cut spending by 20% in a state budget, which is, you know, roughly 1/3 spent on healthcare, not something you want to cut now, 1/3 on education, not something you want to cut ever, 1/3 spent on everything else. There's not really a good policy option. There's a good federal option. What would I do for the federal government? I would do two things. One is a large slug of unconditional money, say $500 billion, and small conditions. You can't use it to pay for tax cuts, for example. And then on top of that, I would take the amount of Medicaid money that is paid out, because Medicaid is partly paid by the federal government, partly paid by the states, something called FMAP, and I'd raise that matching rate for Medicaid. That's something I have a proposal that I developed that would be based on state unemployment rates. It's something that the House has included in legislation. So we only have about 4 more minutes. There's so many great questions here. Do I anticipate inflation catching up? The markets expect over the next 10 years inflation to be 1%. The markets think the odds that inflation is above 4% are less than 5%. I agree with the markets on the low expectation for inflation. I think there's a little bit more of a possibility of high inflation than the markets think. As I said before, I think that's good news, not bad news, and not something we worry about. There is a lot of uncertainty because the supply shock might say we get inflation, the demand shock might say we get deflation, and we don't know the ratios of them. But so far, you know, I think it's hard to have inflation without a wage price spiral, without commodity prices going up. So, you know, a lot of questions about the global situation. And I think Ricardo Hausman is doing a future session and will focus more on the global side. I think, Erica, you're nodding. Yeah, so I was focusing more on the United States. A lot of what I said is completely applicable to other advanced economies and is somewhat applicable to emerging economies. Emerging economies face a lot of problems: harder access to capital markets, more fiscal constraints, more dependent on commodity exports, which have gone down in price, more dependent on exports, and the export markets are closing down. If there was a large return to protectionism in places like the United States, that would be a real problem. You know, so far you've seen it more directed at China rather than globally. I think that's not great, but I think doing it globally would be even worse. You know, there has been a little bit the advanced economies have done, like debt moratorium for the poorest countries, but not nearly enough, not nearly for enough countries for as long a time, as much as is needed. And the question is, how can you get outward-looking attention when, number one, the advanced economies themselves are suffering, and two, the leading economy in the world is headed by a president that is not very internationally oriented, not mobilizing a response. And number three, when China, which is a large creditor to a lot of countries around the world, has no experience in debt restructuring and debt forgiveness. And all of that is, I think, a big problem for will the international economy rise to the challenge. You know, see many other questions here. I apologize that I wasn't able to get to all of them, but this will be an ongoing discussion, and I think that it's the most important economic event almost any of us, unless you're extremely old, have lived through, and it will be important to do everything we can to get that right. That's a skill that we try to teach at the Kennedy School, a skill we try to go through in executive education, and something the 1 hour I just did today doesn't do justice for. But I encourage you to take advantage of a lot of the opportunities our school will be providing and that you can get elsewhere on this as well. So thank you.
Great.